Howdy everybody, it is time for more Accounting 1101. We are looking at internal controls in our unit right now, and in our video today we're going to be looking at internal controls as they relate to cash payments. How do we have our control system set up to handle money going out the door? So let's get right to it. What you're going to learn, our goal in today's video, we want you to be able to describe and illustrate the application of internal controls for the cash account as they relate to payments going out the door, cash payments. And so we're looking at the control procedures that we have surrounding our cash payments, and that's an element of internal control. We had a previous video where we talked about the 5 elements of internal control and how you needed to be familiar with those and be able to talk about them and give an example of every one of them. So here we are, cash going out the door, cash payments. What are the controls around cash payments? Our 2 big goals here with money going out the door. We want to make sure that money going out the door, those payments are only for authorized transactions. We don't want to have a scenario where people are spending money, the business's money, that they aren't authorized to spend. And we also want to avoid a scenario where we have someone going rogue and they're using business money to maybe buy things that aren't for the company. And they're using our business money to pay for personal items. And you see sometimes every now and then in the news, you'll see an employee get busted for reimbursement fraud. Maybe a governmental employee has turned in receipts that weren't actual expenses of the governmental unit, and personal expenses instead, and then they get busted on. You see about those stories in the news every now and then. The other issue here, our cash controls with payment, is we want to make sure that our cash is being spent efficiently and effectively. And so what does that mean? You may remember in the previous chapter we talked about those discounts, payment discounts. If we pay early, we get a percentage discount. And normally it's in our best interest to do that because we're paying less and we're getting more of a break on the price than whatever we could be getting had we invested that cash somewhere else. So an efficient way to spend cash is making sure that we get all the discounts that we're entitled to. So our controls over payments, and you can kind of look at it from 2 different standpoints. If we're talking about a small business, maybe the owner and manager are kind of one and the same. The person that owns it kind of fulfills that management function. Normally they know everything that's going on. The business is small enough where they kind of have their hand in all of it. So that owner manager might be the one who not only orders goods, but they also inspect them when they come in, make sure they got what they ordered, and they also authorize the payment, sign the check so the goods can be paid for. And so in a small business, one person, the owner, may fulfill all those different functions. Of course, in a bigger business, maybe one with a lot of different locations, or maybe one that's just so big one person can't do all that as an owner, you'll have various employees fulfilling all those functions. And again, the internal control here is to build walls, a separation of duty between the different functions and departments. So we may have a purchasing department responsible for placing orders. We may have a receiving department responsible for making sure those orders are correct when they come in. And then we may have another department, the accounting department maybe, or the treasurer who's making the payments for the invoices. And of course, when you have different departments and different people, there's a coordination that has to go on there. And we have to have some kind of maybe electronic or paper trail to coordinate the activities of the various departments. But again, the big point here, from an internal control standpoint, is we always want to have a separation of duties. And that way, one person doesn't have so much control that they can maybe steal money and then cover it up. So to help us do that, we have a thing in larger businesses called the voucher system. And a voucher is simply any kind of document that can serve as proof of authority to pay a bill or to pay an invoice. And so a voucher is just part of our paper trail. Voucher system is all the procedures put together for kind of recording the liability and the expense and then the cash payment. And so our voucher system might involve a couple of different things here. It might involve the purchasing department issuing what we call a PO or a purchase order. Hey, we're going to make an order. Here's what we're ordering. And then it might involve a receiving department getting that material, getting that inventory, getting those goods, whatever it might be, and inspecting it, making sure that what came through the door is what was ordered. And then they'd fill out a document or a receiving report, and they would take the invoice that came with it and combine them. And then all of that might be forwarded to the payment department, whatever department in the organization that might be, maybe the accounting department, the treasurer's office. But they would prepare the voucher. The voucher would include all the support, the PO, the receiving report, the invoice, all those together. And they would make sure everything ties out and matches up, and then they would authorize payment. And so you can see those separations there. Someone couldn't buy something and then receive it and steal it. You know, I couldn't buy something with the company's money and then have it sent to me and steal it because it has to go through receiving. So there's a wall right there. And we create a wall between the receiving and the payment. And so by separating those duties, one person can't just spend the company's money on things for themselves, right? And then get it, or they can't create payments on something that wasn't ordered. Someone in the payment department couldn't issue a check to pay their credit card bill for their personal expenses because it'd have to go through purchasing. So those walls right there protect us in that system. Some other payment controls that we have, all cash payments need to be made by a check or an EFT. And you might read in your book about petty cash, you know, a little box of money we keep on hand to pay for things like maybe I need to get a book of stamps real quick, $10, and I don't want to go through the formal process. Maybe I'm going to treat everybody to donuts one morning, and I don't want to have to go through the formal process of getting a check. And so really, really minor, small amounts we might pay out of petty cash. You know, keep $100 or $200 sitting in the office to pay those expenses. But for the most part, we want to have all the payments made by a check or an electronic funds transfer. All our checks are going to be pre-numbered, and we're going to make sure they're secured and accounted for. We don't want to have a situation where somebody's going to steal a batch of checks and maybe be able to write checks out of that batch. We're going to separate the check signing from the preparing. So like I said, the actual authorization of the payment might be separate from the generation of the payment. So our final video in the internal control series, we're going to talk about probably the biggest internal control surrounding the cash account, and that's called a bank reconciliation. We're going to get that statement from the bank that shows our balance, and we're going to check it against our accounting records and reconcile those two numbers. Very important control in business, and you'll find out more about that and how to do a bank reconciliation in our next video. We'll see you then.